Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. The worst collapse in ARK Invest history is currently on its way. In the last year, ARK's flagship ETF has lost about 40% of its value, while the S&P 500 has gained nearly 25%. For ARK investors, this is worrying. The root cause of this underperformance is the macroeconomy. ARK Invest will continue to plummet if these factors are not reversed or at least addressed. In this video, we'll find out what those factors are, as well as what Cathie Wood has to say about the downturn at ARK Invest. The Federal Reserve has completely failed to save America's economy. How? Equities and consumer prices accelerated to all-time highs as Fed Chair Jerome Powell printed excessive amounts of money during the COVID-19 outbreak. The Federal Reserve is now doing the exact opposite. The Federal Reserve is rapidly reversing its earlier decisions and will soon withdraw funds from the economy. The Fed expects to stop buying bonds, popularly known as quantitative easing, by mid-March. From then, the Fed will start selling bonds and boosting interest rates to reduce its balance sheet. To put it another way, the Fed turned on the money printer in 2020 and 2021. But in 2022, it will use a vacuum to suck back a considerable chunk of that money. This will probably have a short-term negative impact on the economy, which is already factored into current valuations. This is because bond rates must rise when the Fed sells bonds. Increasing interest rates are a concern for innovative businesses since they need to borrow money all the time to keep developing. Higher interest rates increase the cost of borrowing, which would be detrimental to innovative businesses. Bond yields have lately risen, and investors expect them to continue to rise. As a result, ARK Invest-related equities continue to plummet week after week. So here's the main question: when will all this confusion end, and when will the innovation continue? So yeah, the answer for that has something to do with inflation. If the Fed's retraction causes innovation to slow, it's quite likely that the Fed will return to quantitative easing, which involves the Fed buying bonds. On the other hand, if inflation continues to rise to new highs, the Fed will have to choose between sticking to its current strategy or becoming even more aggressive in its retraction. To simply explain this, if inflation decreases, the money printer will most likely turn back on, benefiting ARK Invest. If inflation rises, the money vacuum will persist, causing ARK to plummet even further. For a variety of reasons, Cathie Wood believes the first situation will occur. But first, let me discuss her theory on why ARK keeps crashing. The second scenario we discussed, in which inflation remains high, has been priced in by algorithmic traders. Many investors believe that algorithmic traders improve market efficiency, yet the opposite happens. During the early stages of the COVID-19 pandemic, algo traders concentrated on shorting companies that were losing money and had little cash on hand. These algorithms work in general, but not in all industries. Genomic stocks, for example, fulfilled those criteria and were significantly penalized as a result. Any rational person, on the other hand, would know that genomic firms would have a role in the pandemic solution. After being punished for a month, genomic stocks began to rise. Cathie says we're in the same boat, but with almost all innovative stocks. Because of inflation fears and rising interest rates, algo traders are punishing riskier stocks that are rotating into value. High valuation multiples, minuscule earnings, diminishing revenue growth, and poor cash cushion repercussions are just a few of these traits. Zoom and Teladoc are two of ARK's highest conviction equities that follow these traits. Both of these stocks are on their way to being completely destroyed since they're down around 70% from their highs. ARK's largest stake is Teladoc, while its fourth largest position is Zoom. These two stocks have been compared to tech companies during the dot-com companies by investors. But for Cathie, they're completely incorrect. She believes the dot-com bubble was premature.
The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. You know, Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison that we're going to see, and this is the last of the really tough comparisons. Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%, and that's probably the low point of its growth rate, we believe, or Zoom's revenue growth is going to accelerate from there.
The main question here is, when will this crash be over? ARK will almost certainly bounce strongly once inflation begins to moderate. Cathie feels that various indicators suggest that inflation will slow significantly in the next months. Cathie's indicators are not covered by the regular financial media, which effectively brainwashes investors into believing that inflation must continue to grow. The first indicator is the cost of a used car. For decades, economists and financial experts have used the Manheim Used Vehicle Value Index to track used car values. This index rose dramatically during the pandemic, but new data suggests that the bubble may be about to pop. At its peak, the index grew at 60% annual rate, but prices have recently started to fall at a rate of 1.2% month over month. This is a significant shift, indicating that inflation may be more transient than people believe. Consumers have begun to establish their own second-hand vehicle inventories, and this inventory momentum can't last forever.
I think this is the most fascinating part of what's going on in the economy right now. The Manheim Used Car Index has been screaming. I think the prices of used cars at their peak had increased on a year-over-year basis something like 60%. And that was adding to the CPI. Well, very interestingly, we've had a few reports now that suggest that the bubble was in used cars and that it might be bursting. We can see this a few ways. On a year-over-year basis now, used car sales units are falling. They're down 4%. November to December, they were flat, but year-over-year, that was down 4%. We're seeing prices finally start to fall. They were down 1.2% month to month. Again, that's a big decrease month to month. Annualized, roughly 12%. On a year-over-year basis, they're still up 46%, but they have started to fall. And what tells us that they will continue to fall, and mind you, they've had a disproportionate impact on the CPI. What tells us they will continue to fall is now an inventory buildup in the used car space. Normal inventories for used cars are, I believe, 43 days. Now they are at 54 days, so well above average. And I believe at their lows, they were in the 20-day supply range. Now, many people are looking at the hike in used car prices, and they've probably been thinking about selling that car and that extra car maybe that they bought to avoid mass transit during the coronavirus. If they see prices coming down, they probably will move a little more quickly.
Consumer sentiment is the second indicator that Cathie is keeping an eye on. Although consumer prices are rapidly rising, this does not necessarily indicate a high level of consumer demand. It is low supply, not strong demand, that's the primary source of inflation. The current consumer demand is not being met by supply chains. However, that demand is already declining. Retail unit sales are only increasing by 0.3% month over month, which is not keeping pace with the 0.77% growth in consumer prices. This indicates that consumer spending power is not keeping pace with rising prices. The Consumer Sentiment Index at the University of Michigan, which is fast falling to new lows, represents this very well.
Consumer sentiment is down to levels that we last saw at the depth of the coronavirus, both in November and December. Now, that's a very important part of the time of the year for the consumer to be feeling unconfident because it's the biggest selling season of the year. And so that, we believe, has become a problem. We have numbers for November. Retail sales were down they were up 0.3%. But when you take inflation out, what did real spending do? So what was unit growth in retail? It was down 0.3%. If you annualize that, that's about 3.5% at a really important time in the year. Retail sales are mostly goods. If you add in services, you see that real consumption in total, goods and services, was flat. Again, very important time of the year, and a time also when we thought this pent-up demand for services would cause a burst in service consumption.
The US GDP is also pointing to a significant buildup in inventory, in addition to the used vehicle bubble popping and consumer sentiment weakening. The total amount of products and services sold in a country is measured by the gross domestic product, or GDP. The US GDP has been expanding recently, which appears to be a good thing, but firms purchased new inventory that isn't being sold, which accounted for the full GDP increase. The whole GDP growth is accounted for by wholesale and retail inventories, which has major ramifications. Prices will have to drop if businesses are stocking up on goods that aren't being sold.
In the third quarter of last year, real GDP was up 2.3%. It was a big disappointment relative to expectations. But what the headlines did not feature, and still are not featuring, is that practically all of that growth went into inventories. It wasn't sold. Real final sales were up a tenth or maybe 2/10. So even in the third quarter, now remember, that's reaching back to June. Even in the third quarter, inventories were starting to build at a time when everyone was talking about supply chain problems. And I think what we were beginning to see is the consumer getting quite upset that necessities, the prices of necessities, were escalating and destroying purchasing power. So that's interesting. Now, what gets even more interesting is watching the inventory numbers in the fourth quarter. Wholesale inventories in October were up something like 2.5%, 2 to 2.5%. Now that's month to month, that's not year over year. Annualize that, and we're talking about 25 to 35% increase in inventories. Remember, this is when supply chain issues were causing all kinds of shortages. And then again in November, wholesale inventories up 1.2%, again, double-digit rate annualized. Part of the reason is consumption was not playing ball. And then you look at retail inventories in November, up 2%. That's month to month, annualized. Annualized, 24% plus. So this is something I don't think the headlines have captured. you might be surprised to hear it as well.
The Purchasing Managers Index, or PMI, is the last significant measure that Cathie is keeping an eye on. The PMI is a poll conducted by the country's top purchase and supply executives. This measure has recently dropped by about 4% month over month, indicating that consumer spending power is rapidly decreasing. So this is what Cathie said about the December statistics they've got.
And the other December statistics that we got, besides autos, are the PMIs, the total PMI and PMI for services. Both of them came down, and prices paid in the Purchasing Managers Index came down a lot more than people were expecting. It was, I think the expectation was somewhere around high 70s, 80. This is a diffusion index. Instead, it was 62. Now, that still means prices are up because they're still above 50, that diffusion index. But coming down, we think, pretty fast.
Many indications have been discussed that suggest inflation may slow down in the future. If there will be other causes, such as continued supply deficit, ARK's ETFs might easily crash even more. Cathie, on the other hand, has a lot on ARK's recovery, and she certainly believes in it. She recently revealed that ARK Invest holds more than half of her IRA, so she has a stake in the outcome. And here's what Cathie Wood had to say to us.
I want you to know that we're in there with you between the company and ARK funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher. That the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes.
And that's it on why ARK Invest continues to crash and what it will take for it to recover. So what do you think about it? If you have any thoughts, you can share it on the comment section below. I hope you enjoyed the video. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.